Well, Zoom Communications delivered a solid quarter of results as the company announced that it has exceeded guidance in both revenue and profitability. For more, we're joined by Peter Weed, Senior Analyst of Cybersecurity at Bernstein. He joins us right now. Peter, thanks a lot for joining us. This stock has rallied recently. Take us through some of the highlights of these results from Zoom Communications.
Yeah, I mean, one of the big concerns around Zoom is how does it perform during kind of difficult macro, particularly in a segment that appears relatively competitive. And, I think they dispelled quite a few of those worries, both showing on the enterprise segment of their business, very strong existing customer renewals and continued growth. And even on the online portion of their business, that's a little bit more consumer oriented that you could, worry might be more, flighty in difficult market positions. They actually had a reduction in their churn rate. And so you put both of those things together, and that delivers a business that continues to be very solid, flowing all the way through to the bottom line, where Zoom has been adding, quite a few AI features to their products, some of which they're kind of giving away for free. And you could worry that those might pressure the margin of the business, but actually they continue to deliver on a non-GAAP basis, nearly 40% gross margin. So when you took both the top line and that bottom line performance, I think the street was generally happy with the delivery.
You mentioned churn, and I'm seeing from some of your notes in reaction to these results that among large enterprise customers, retention was 98%. That is very low churn, correct? Is that typical, a retention of 98%?
I mean, that is kind of the best of the best, as you can imagine. In any market, you have almost what you would call structural churn, companies going out of business. So it's pretty much impossible to get to zero. And so when you get into those very high 90s, it basically says every customer who can stay with you is staying with you. And, I think that's a signal of the strength of the Zoom product with their enterprise customer base.
How competitive is the space?
If you look around, obviously we're, I'm connected right now through Microsoft Teams. There are, Google has products in the space. There are legacy products out there. And so it would appear that there's a lot of potential ways that you could use collaboration products that are out there. Microsoft with Teams has been very successful, particularly for kind of inside company collaboration. That product is often given away for free as part of their licenses. So the fact that you would pay up for Zoom, I think kind of demonstrates some of the value that they've been able to offer to customers and their clients with the broader functionality of the suite.
So you like the company's performance. It sounds like you think management's doing a good job. On the stock, however, it looks like you think the stock is fully valued or getting there. You have a market perform rating on the stock and a price target of $89 per share. How do you get to that price target?
It's the one kind of controversy with this company is that they have quite a bit of cash. And if you took the cash and the cash flow the business have, you might actually be able to have a model that would say, hey, there should be upside in this. The company has expressed an interest in using that cash to potentially buy other companies. That creates a level of uncertainty around the valuation for that. In addition, the company has had a reasonably high level of stock-based compensation. And so there's ongoing dilution. And so you take what is kind of good performance on the revenue and on the margin side and add some of these uncertainties on the ability to capture that over the long term. Plus, there's just kind of ongoing questions about how does this market evolve? What's the tail value of the business? Some of the things that, I might take a look at other things in my coverage where it's easier to understand that long-term durability. They do get, a little bit hit for those. And so, they kind of maybe a little bit unfairly, in their perspective, get pulled down on a valuation basis. And that's why we've ended up kind of with the market perform, is that when you look at those relatively low growth, some of the long-term questions around the cash and what the tail value of the company is, it does, create some reasons to pause.
Peter, thank you so much for this insight on Zoom Communications. Peter Weed is Senior Analyst of Cybersecurity at Bernstein.